Does it drive you crazy watching people with your exact same salary get ahead financially while your money is just sitting in a savings account doing absolutely nothing? Here's the brutal truth nobody wants to tell you. The reason you're not building real wealth has nothing to do with your salary, your education, or even the stock market. It's because you completely ignore the most powerful financial force on the planet. The bond market controls every dollar you'll ever make, spend, or lose, and you don't even know it exists. I'm about to show you exactly how this $100 trillion market secretly decides your mortgage payment, your retirement timeline, and whether you'll ever escape the paycheck to paycheck trap. By the end of this video, you'll understand why smart money pays attention to bonds even if they never buy a single one, and how you can finally use this knowledge to build actual wealth instead of just hoping things work out. Let's start with what everyone gets wrong about bonds. Most people think they're boring investments for grandparents. That's like saying water is boring until your house catches fire. Bonds are the economy's thermostat. They control how expensive it is for everyone to borrow money. You, me, corporations, even the government. When bond yields spike, everything changes. Housing slows down, stocks tumble, even Bitcoin gets nervous. The bond market isn't some sleepy corner of finance. It's literally running the show, while the stock market just performs for tips. So what exactly is a bond? Think of it as lending money with superpowers. When you buy a bond, you're essentially giving someone an IOU in reverse. They owe you money, and they promise to pay you back with interest by a specific date. Every bond has 4 key parts you need to understand. The principal is the amount you lend them, also called the face value. The coupon is the interest rate they pay you annually. The maturity date is when they give you your money back. And the yield is what you actually earn based on what you paid for the bond. Here's where it gets interesting and where most people's brains start hurting. Bond prices and yields move in opposite directions like a financial seesaw. When interest rates go up, existing bond prices drop. When rates fall, bond prices rise. Why does this happen? Imagine you own a bond paying 5% interest. Suddenly, new bonds start paying 6%. Nobody wants your 5% bond anymore unless you sell it cheaper to make up the difference. Let me give you a real example. Say you buy a $1,000 bond paying 5% annually. That's $50 per year. But if that bond starts trading for only $900 instead of $1,000, you still get the same $50 annually. Now your actual return is 50 divided by 900, which equals 5.56% instead of 5%. The yield went up because the price went down. This relationship affects everything in your financial life. Your mortgage rate typically follows the 10-year Treasury yield. When bond yields rise, your monthly housing payment goes up. Credit card rates follow short-term Treasury rates. When those spike, your credit card interest can hit 20 or 30%. Your retirement accounts feel it too. When bonds start paying higher returns with zero risk, people bail out of stocks, causing market drops. This creates a ripple effect through your entire financial world. Every time the bond market moves, it's like someone changing the price tags on your life while you weren't looking. Housing gets more expensive, credit becomes pricier, and your investment returns shift. Many people wonder if they should even care about bonds if they're young and focused on growth. Here's the reality. Even if your portfolio contains 0 bonds, the bond market still controls your financial future. Understanding this dynamic helps you make smarter decisions about when to buy a house, refinance debt, or adjust your investment strategy. The bond market operates in 2 stages. First is the primary market, where governments and companies create new bonds to raise money. Think about our government's situation. We bring in money from taxes, but we spend way more than we collect. The difference gets covered by issuing bonds. We're basically asking people to lend us money to keep the lights on. In 2024 alone, the government overspent by $1.8 trillion. That's not a rounding error. That's Ferrari money every single day. This creates a massive demand for bond buyers, and those buyers include banks, pension funds, foreign governments, and regular people like you and me. The second stage is the secondary market, where people trade bonds like stocks. The U.S. Treasury holds regular auctions where investors bid on the privilege of lending Uncle Sam money. These auctions set the benchmark rates that ripple through all other borrowing costs in the economy. Here's what makes this situation scary. The U.S. hasn't run a budget surplus since 2001. We currently owe about 122% of what we produce as a country. Imagine owing more than you make every year while still applying for more credit cards. That's essentially our national situation. A huge chunk of government debt is short-term, meaning we constantly refinance it at current rates. When rates jumped higher, our interest costs exploded. Eventually, we might spend more on interest payments than on defense or healthcare. The only solutions involve higher taxes, more debt, or budget cuts, and none of those make anyone happy. This connects directly to your personal wealth building. The relationship between bonds and stocks works like mirror images. Treasury bonds represent the risk-free rate. They're steady and predictable. Stocks are the drama queens, going up and down based on emotions and expectations. When you buy a stock, you own a piece of a company. When you buy a Disney stock, you own part of Disney. When you buy a Disney bond, Disney owes you money. The bond is safer, but the stock has more upside potential. The difference between bond yields and expected stock returns is called the equity risk premium. This gap shows how much extra return investors demand for taking on additional risk. When bond yields rise, stocks need to offer even higher potential returns to attract investors. This creates pressure on stock prices and can trigger market corrections. Understanding this relationship helps you anticipate market movements and position your investments accordingly. People often ask whether they should buy bonds directly or just understand their impact. For most investors, understanding the impact matters more than owning bonds themselves. Knowing when the Federal Reserve might change rates helps you time major purchases like homes or cars. Recognizing when bond yields are attracting money away from stocks helps you prepare for market volatility. The key insight is that bonds control the cost of money itself. When bonds move, everything else moves with them: your mortgage rate, credit card rate, investment returns, and even job market conditions all respond to what happens in the bond market. Smart investors track bond yields not because they plan to buy bonds, but because bond movements predict changes in every other market. When 10-year Treasury yields spike above 5%, housing activity slows. When yields drop below 3%, refinancing activity explodes, and stock markets often rally. You can use this knowledge practically. If bond yields are rising rapidly, consider waiting to make major purchases or lock in current rates quickly. If yields are falling, it might be time to refinance debt or increase stock allocations as money flows toward riskier assets seeking higher returns. The bond market also reveals economic expectations. When investors buy long-term bonds despite low yields, they're betting on slower future growth. When they demand high yields on government bonds, they're worried about inflation or fiscal stability. This information helps you make better financial decisions. Rising bond yields often signal good times to lock in high-yield savings rates or consider adjustable-rate loans. Falling yields might indicate opportunities in growth stocks or real estate refinancing. Understanding bonds transforms how you view financial news. When headlines discuss Federal Reserve meetings or inflation data, you'll grasp why markets react so strongly. These factors directly impact bond yields, which then cascade through every other asset class. The most important takeaway is this: you don't need to become a bond expert, but you absolutely need to understand their influence. The bond market is the steering wheel of the entire financial system. Ignoring it means letting someone else drive your money while they scroll social media. Your path to wealth building becomes clearer when you understand these connections. Instead of just watching stock tickers like scoreboards, you'll recognize the underlying forces moving all markets. You'll anticipate changes before they fully play out in stock prices or housing costs. This knowledge gives you a massive advantage over investors who only focus on individual stocks or trendy investments. While they react to market movements, you'll understand what caused those movements and position yourself accordingly. The bond market might seem complex, but its basic influence is straightforward. Higher yields mean more expensive borrowing across the economy. Lower yields mean cheaper borrowing and more risk-taking. Everything else flows from these fundamental relationships. Start paying attention to bond market news with this new perspective. When you hear about Treasury auctions, Federal Reserve decisions, or government spending debates, consider how these factors might affect bond yields and subsequently impact your personal finances. Remember, building wealth isn't about finding secret investments or timing perfect market entries. It's about understanding the fundamental forces that drive all markets and positioning yourself to benefit from those forces rather than getting blindsided by them. The bond market will continue influencing your financial life whether you understand it or not. The choice is whether you want to harness that influence or remain its victim. Smart money chooses to understand and adapt. Now you have the knowledge to make that same choice. What's the biggest misconception you had about how bonds actually work, and which part of your financial plan do you think will be most affected by what you learned today? Tell me your answer in the comments below. There are no wrong answers, just real strategies for your actual life. If this video helped you see the financial matrix a little clearer, leave a like and subscribe so you don't miss the next wealth building strategy. See you in the next one.